In accounting, every number tells a story and explains what a business owns, what it owes, how it is financed, and how profitable it is. Accountants are responsible for recording each of the business's transactions in a format that can quickly summarize the information into exactly what owners, managers, and investors want to see. And the starting point for the accountant's work is the analysis of business transactions, which is what you'll learn about in this video. The accountant's work tends to repeat month after month, and the accounting cycle outlines all the steps accountants complete on a monthly basis. Today, we'll focus on that initial step in the accounting cycle, the analysis of business transactions, and specifically a tool called the accounting equation. It all begins with step one, analyzing business transactions, followed by journalizing the transactions, posting the entries, preparing the worksheet, the adjusting entries, closing entries, the post-closing trial balance, and interpreting the financial information. Again, it all starts with analyzing the transaction and determining whether the transaction meets the basic requirements to be recorded. For one, the transaction must be able to be measured in US dollars, and it has to be an event that changes the resources or financial interests of the business. Or said another way, we record only those transactions that change what the company owns, what it owes, what it earns, and what it spends. And that is what you'll learn in step one. Determine if a business transaction is worthy of being recorded by the accountant and how to record it into the financial records of the company. We'll start slow, and at the beginning of our analysis, we'll use a simplified basic version of the accounting equation so that you can understand step by step how we arrive at the fundamental accounting equation we'll continue to use throughout this class. The simplified accounting equation basically states that the property of the company is equal to the financial interest in the business. Property includes things like cash, supplies, land, monies owed by customers called accounts receivable, equipment, building, prepaid expense, and inventory. In short, things that the company owns. Financial interest, on the other hand, are monies owed by the business to suppliers called accounts payable, monies received in advance from customers, monies owed to the owners of the business, notes payable, and bank loans. In short, financial interest is what the company owes to others, either third parties or the owner of the business. And an important thing to remember is that every transaction affects at least two accounts, but the equation must always remain in balance. So if the property side goes up, the financial interest side must go up as well, or property would not equal financial interest. If property goes down, then financial interest must go down as well. Now, you could have a transaction that only affects property when one property category goes up and another one goes down, or a transaction that only impacts financial interest as long as the equation still holds true. The example our textbook uses is Eli's Consulting, which is a new business founded by Trayton Eli and offers accounting and consulting services. There's also an office manager, Sergio Sanchez, who handles the day-to-day office management responsibilities. Customers are billed monthly, and some pay right away, and others receive credit, meaning they can pay later. To start his business, Trayton Eli took $100,000 of the money he had personally saved and opened a business checking account in the name of Eli's Consulting Services. And the separate bank account helps Eli keep his financial interest in the business separate from his personal funds. We're just about ready to record this first business transaction for Eli's Consulting, but let's first talk about the basic steps we'll use in this process. First, we'll describe the financial event by identifying whether property or the financial interest increased or decreased. Super important, there are at least two accounts for every transaction. Call it the yin and yang of accounting. The second step is to make sure the equation is in balance. So let's practice this process with the help of Eli's Consulting's first transaction. For the first transaction of this new business, Trade and Eli puts $100,000 of his personal money and deposits it into the business's bank account. So in step one of the process we just talked about, we described the financial event. Eli's Consulting now has more money in the business's bank account, $100,000, and will use the account cash for that. In a business, you'll likely use the name of the bank as the description, like Bank of America checking or Citibank checking. For simplicity, we'll just use the account name cash. Next, we'll need to figure out what kind of account cash is. Is cash something the company owns, meaning property, or is it something the company owes, meaning financial interest? We can see that the account cash is listed as one of the accounts that is part of property. That means cash increased by $100,000. Cash is a property account because it is property that the company owns. Next, we find that monies owed to the owner, Trade and Eli, also increased by $100,000 because he expects to be repaid at some point in the future. Monies owed to the owner fit into the financial interest category, which means that the financial interest side increased. Next, for step two of our process, we need to make sure that our equation property equals financial interest is in balance. And we do that by using this table that checks that the property side equals the financial interest side. We start by adding the two accounts we'll be using, cash on the property side and Trade and Eli Capital on the financial interest side. Now, when we analyze the transaction where Trade and Eli invested $100,000 cash in the business, we said that the cash account increased. So we write plus $100,000 in the column for the cash account. We also said that the monies owed to the owner increase, and that means we write plus $100,000 in the column for the Trade and Eli Capital account. And to check that our equation still balances, let's calculate the new balance, $100,000 on the property side and $100,000 on the financial interest side. And both sides show the same amount, and accountants say it balances. Property equals financial interest. That is a very important step in this process to make sure the equation is in balance. And we did it. We analyzed our first business transaction for Eli's Consulting. We entered the transaction into the equation table, and we made sure that it balanced. Property of $100,000 equals financial interest of $100,000. And if you're ready, we can work on the second transaction. In this second business transaction, Eli's Consulting issued a $5,000 check to purchase a computer and other equipment. So let's describe the financial event in step one of our process of analyzing the transaction. The firm purchased new property, the equipment, and equipment is a type of property. That is part one of the transaction. But remember, every transaction has at least two parts. So for part two, the company also has now less cash. And cash is also a property of the business. So equipment on the property side increased and cash on the property side decreased. To record this transaction and to keep things organized, we'll add another category on the property side for equipment and record the second transaction. We write plus $5,000 in the equipment column to show that we now have more equipment, and write minus $5,000 in the cash column to show that we now have less cash. Does the equation still balance? Well, let's calculate our new balance: $95,000 in cash, $5,000 in equipment equals $100,000 in property. And the financial interest side shows $100,000 as well. So does it balance? Yes, it does. Next, Eli's Consulting purchased office equipment on account from Office Plus for $6,000. Buying on account or buying on credit means that you don't pay the full amount right now. It means that you promise to pay the amount at a specific date in the future. As accountants, it's important that we keep track of the amounts owed. So let's analyze the transaction so that we can enter it into the accounting equation. Eli's Consulting purchased new property equipment for $6,000, which means that the property side of the equation increased. That's part one of the analysis. Let's look at part two. Eli's Consulting now owes $6,000 to Office Plus, which means that the financial interest side of the equation has increased because monies owed to suppliers is a financial interest category. And we're ready to write this transaction into our equation by writing plus $6,000 in the equipment column to show that the company now has more equipment, and then adding another category for accounts payable on the financial interest side and writing plus $6,000 in the accounts payable column. Let's calculate our new balance: $95,000 in cash, which is unchanged, and $11,000 in equipment equals a total of $106,000 in property. And the financial interest side shows accounts payable of $6,000 and capital of $100,000 for a total of $106,000 of financial interest. So do both sides of the equation balance? Yes, they do. Let's now look at the fourth business transaction. Eli's Consulting issued a check for $1,500 to Office Deluxe Inc. to purchase office supplies. And we can now analyze this business event. The company now has more office supplies. Office supplies is something the company owns, meaning property, so an increase to the property side of the equation. And the company's cash decreased because Eli's Consulting issued a check, and we're ready to write that into our table. We'll add an additional column for supplies to keep things organized and separate, and add $1,500 in that column. And for the second part of this transaction, we'll write minus $1,500 into the cash column. The new cash balance is now $93,500, and when we add up all the property accounts, cash, equipment, and supplies, the sum is $106,000, which is the same total amount for the financial interest accounts. And the equation still balances because both sides of the equation show the same amount of $106,000. Let's continue with the fifth transaction. The office manager, Sanchez, paid $2,500 to Office Plus to reduce the firm's debt. This is related to our third transaction when Eli's Consulting bought a computer equipment on account from Office Plus for $6,000. When we analyzed that original transaction, we increased the equipment account and we increased accounts payable. Now that Sanchez pays part of the $6,000 that Eli's Consulting owes Office Plus, we need to figure out what to do with this business transaction. So first, we need to reduce accounts payable because Eli's Consulting now owes less money to Office Plus. And for the second part of this transaction, we need to reduce the cash account because Eli's Consulting now has less cash. To write this transaction into our equation table, we write minus $2,500 into the cash column, and we write minus $2,500 into the accounts payable column. We calculate the sum for each column: $91,000 cash, $11,000 in equipment, $1,500 in supplies, for a total of $103,500. And on the financial interest side of the equation, we also have $103,500. So our equation is still in balance. The sixth transaction occurs when Eli's Consulting rents office space. The landlord required that rent for the first 2 months, December and January, for a total of $8,000 be paid in advance. That's not uncommon. Quite often, commercial property landlords will want a deposit and several months of rent paid in advance. Now, there are special accounting rules when it comes to expenses that are paid in advance. In accounting, this prepayment is considered a form of property because the business could get a refund potentially if it did not use the facilities the entire time. So what do we need to do when Eli's Consulting issues a check for $8,000 to pay for rent for the month of December and January? Let's break it again into part 1 and 2. First, the business now has a new property account called prepaid rent. So prepaid rent, a property account, increased, and the company's cash account decreased. To record this transaction, we'll add the new account prepaid rent into the property side of our equation and add $8,000 in that column. We need to also reduce cash by $8,000, so let's write minus $8,000 into the cash column. And let's double check that our equation still balances. Cash, equipment, prepaid rent, and supplies total $103,500, and so does the financial interest side of the equation, which means that we still balance. The table we've been using provides us with a lot of information already, and it's really interesting that these numbers already tell a financial story about this business, such as how much cash is available, $83,000, how much the company owns in terms of equipment, $11,000, prepaid rent, $8,000, supplies, $1,500, and how much the company owes to others, $3,500 in accounts payable and $100,000 to the owner. And we only recorded 6 transactions, so it's still fairly easy to have a good overview of the amounts. However, you can probably tell that recording thousands of transactions in a typical business and providing that information to internal and external users in the form of an accounting equation table may not be really helpful. That's where financial statements come into play. Accountants prepare financial statements in a standardized format to summarize the accounting transactions so that the company's financial story is much easier to understand. One of the first financial statements you'll learn about is the balance sheet. And we have all of the information that we need in our accounting equation table that we prepared. We start by preparing the header section of the report, which shows the name of the business, Eli's Consulting Services, the type of report, balance sheet, and the date for the report, in this case, November 30th. The balance sheet is very similar to the table we prepared. On the left side of the balance sheet, we'll list all property accounts in the column called assets. And assets is the standard word used to describe the property the company owns. On the other side of the balance sheet, we show the financial interest of the business and split it between the money owed to the third parties. We call that liabilities, and monies owed to the owners called owner's equity. And in our example, Eli's Consulting Services prepared the balance sheet as of November 30th. On the asset side, we list the property of the business, cash of $83,000, equipment $11,000, prepaid rent $8,000, and supplies of $1,500 for a total of $103,500 in total assets. On the other side, the financial interest side, we have liabilities of $3,500 and owner's equity of $100,000 for a total of $103,500. And the balance sheet balances, because it shows assets, the property that the company owns, of $103,500. And on the other side, the financial interest side, it shows liabilities to external vendors of $3,500 and the monies owed to the owner, called owner's equity, of $100,000 for a total of $103,500. And that brings us to what we call the balance sheet, or the fundamental accounting equation: assets equals liabilities plus owner's equity. By analyzing just the first 6 transactions for Eli's Consulting, we were able to tell the financial story of this business, what the company owns, what it owes, and how it is financed. This is the power of the accounting equation. But we're not done yet. In part 2, we'll continue analyzing additional transactions for Eli's Consulting Services and deepen our understanding of how everyday business transactions shape a company's financial statements.